Today's video is about the sudden shake-up in the markets. Tech stocks are sliding, AI giants are losing momentum, and Bitcoin took the first hit before anything else even moved.
I have disorder. This is its impact. Okay, let's talk about it later. Now let's talk for Bitcoin's fall. What do you say about this, Mr. Fake?
And that's the part that worries me. When Bitcoin moves first, it usually means the rest of the financial system is not far behind.
Exactly. Even if you're not a crypto fan, this matters. Historically, Bitcoin reacts before the broader market, so understanding this gives us clues about what might be coming next.
So, this video is not Bitcoin fanboy talk. It's about reading an early warning signal for stocks, funds, and even the economy.
Right. And the tough part is, there isn't one simple cause. There are multiple explanations behind this correction.
So let's do this properly. We'll take each theory, no hype, just logic, and break it down so anyone can follow.
Two ways people explain markets. Investors usually fall into two camps when they try to explain markets. First, technical factors. These people stare at charts, patterns, and cycles. To them, markets behave like social systems. When the same pattern appears, people respond in similar ways, and that creates repeating cycles. And the other camp? The ones who say, forget the charts, look at the real world? That's the macro side. They focus on global politics, wars, interest rates, central banks, and global liquidity, basically where the big money is moving.
So one group reads lines on a screen, the other reads headlines and balance sheets, and both think they're right.
Exactly. But no one fully knows which force truly dominates. So to understand this correction, we're going to use both lenses.
Why? The Bitcoin crash is happening 5 reasons.
Technical side, macro side, Fed ending QT, international Bitcoin drama and psychology, Bitcoin IPO moment, whales cashing out.
Let's start with the technical side, because that's where Bitcoin flashed the first warning. One signal traders obsess over is the 50-week moving average. In a strong bull market, Bitcoin usually stays above this line. When it drops below and stays there, that often marks the end of the good phase.
For this cycle, that level was around $13,000. Once price traded below it for several weeks, chart-based traders saw it as confirmation. The bull cycle is over, time to reduce risk.
What makes this more interesting is that the news around Bitcoin was actually positive at the time. Supportive regulations, institutions adding BTC to balance sheets, even large universities buying in.
Exactly. Fundamentals looked bullish, but the chart broke down anyway.
And for strict technical traders, when price action and news disagree, they trust price first. To them, the chart speaks louder than headlines.
Macro side, global liquidity shift. Now let's flip to the macro view, the idea that this is really about global liquidity shifting. Take Japan as an example. For years, it was one of the cheapest places to borrow money. Rates were near zero, sometimes negative.
So global investors borrowed yen, converted it to dollars, bought US assets, and kept the difference. That easy trade is what people call the carry trade.
Correct. But now Japan is raising interest rates. Borrowing in yen is no longer ultra cheap, so that carry trade starts to unwind.
Which means money that used to flow into US markets can start going back to Japan. And once you add in currency and hedging costs, US bonds don't look so attractive anymore.
So large players, pension funds, hedge funds, institutions, may quietly pull capital out of dollar assets.
And when big money steps back, the first things to feel it are risk assets, AI stocks, growth names, and Bitcoin.
Fed ending QT, another macro trigger. There's another important macro signal, the Federal Reserve ending quantitative tightening, or QT. Normally, stopping QT sounds positive because it means the Fed stops draining liquidity.
But the market didn't cheer. Instead, a lot of investors thought, if they're ending QT early, maybe they see something breaking under the surface.
Exactly. That suspicion creates fear, not comfort. So investors step away from high-risk assets and wait.
And Bitcoin, being extremely liquid and trading 24/7, becomes the first asset people dump when they want to reduce risk fast. Internal Bitcoin drama and psychology. There's also a psychological angle coming from inside the Bitcoin ecosystem. For years, there's been a fight over what Bitcoin should be. The old guard says, Bitcoin is money only. Newer developments allow extra data inside transactions, images, files, NFT-style content.
Some investors see that as a problem. It can bloat the blockchain, make running a full node more expensive, and even risk unwanted or illegal data being stored permanently.
So a portion of longtime holders said, I'm going to sit this one out until the community decides what Bitcoin really wants to be. That hesitation adds more selling pressure on top of everything else.
Bitcoin's IPO moment. Whales cashing out. The last theory ties many of these threads together. Some analysts call this Bitcoin's IPO moment. For the first time, the market is liquid enough that early holders from a decade ago can sell billions of dollars worth without completely destroying the price.
In the past, if a whale tried to unload $1 billion in BTC, the market would have collapsed instantly. Now, with ETFs, corporations, and even countries buying, there's finally enough demand to absorb those sales.
So we may be in a phase where early investors are taking profit, new investors are absorbing supply, and the market is repricing.
And that kind of transition is not a one-day event. It can drag out over months, maybe even close to a full year.
Short term, we're dealing with technical breakdowns, global liquidity shifts, and whales adjusting positions. But long term, Bitcoin's incentive structure has repeatedly pushed it to adapt and survive. Through exchange collapses, regulation, forks, and brutal bear markets.
I'm not saying close your eyes and hope. Risk management still matters. But if you believe in the long-term thesis, strategies like dollar-cost averaging can make more sense than panicking on every red candle.
That's where I stand, focusing on long-term positioning instead of chasing every short-term move.
Now it's your turn. What's your theory about this drop? Do you think it's mostly charts, macro liquidity, internal drama, or whales cashing out? Subscribe for weekly finance tips. Hit the bell icon to stay updated.